In the early 2000s, America was dreaming in color. White picket fences, big backyards, a two-car garage, and a flat-screen TV bought on credit. It was a time when everyone believed the same story, that no matter who you were, if you wanted it badly enough, you could own a piece of the American dream. Banks agreed. They opened their doors wide, handing out loans like candy. If you had a pulse, you had a mortgage. And why not? Housing prices were climbing like rockets. Everyone thought, it's safe. Houses never go down. So people borrowed, and borrowed again. A family in Ohio could take out a loan for a home they couldn't afford. A couple in Nevada could buy a second house just to flip it for profit. It wasn't madness, it was normal. On Wall Street, men in suits looked at this ocean of new debt and saw gold. They turned mortgages, the money people owed, into shiny new investments. They packaged them, sliced them, sold them, and named them things so complicated that even experts nodded without fully understanding. From the outside, America looked unstoppable. The Dow was high, unemployment was low, and every main street felt richer than it really was. But below that calm surface, the cracks were already forming. Too many loans built on too little reality. Too much trust placed in systems no one truly questioned. The economy had become a castle made of paper, built high, balanced on promises, and powered by belief. And when belief is all that holds you up, you don't need a storm to fall. You just need one breeze. That breeze was coming. Imagine you're a kid running a lemonade stand. You sell a cup for $1. Then your neighbor says, "Hey, I'll pay you $10 if you promise to sell me lemonade for the next 10 years. Sounds good, right? You take the deal, even though you don't know if you'll still be selling lemonade next week. That's what America's banks were doing with homes. Only instead of lemonade, they were selling loans. People wanted houses, big ones, better ones, second ones. So banks said, sure, here's the money. And when they ran out of good borrowers, they didn't stop. They just lowered the bar. You didn't need a great job or even proof you could pay it back. All you needed was a signature and a dream. They called them subprime mortgages, loans for people who weren't likely to pay them back. But instead of worrying, the banks found a trick. They bundled those risky loans together and sold them to investors like shiny gift boxes. The label said, mortgage-backed securities. Inside, a mix of good loans and bad ones, all tied together. If some went bad, no problem. The others would cover it. At least, that's what everyone thought. Investors around the world, from New York to London to Tokyo, started buying these safe boxes because they paid better interest than government bonds, because everyone else was buying them, because greed has gravity. Money was flowing everywhere, from the hands of families into banks, from banks to Wall Street, and from Wall Street into the entire world. But here's the thing. Much of that money didn't exist. It was paper wealth, value built on the promise that people would never stop paying their mortgages. And when promises are treated like assets, one missed payment can make the whole system tremble. That tremble was getting louder. Wall Street has always been good at one thing, turning complexity into profit. And in the early 2000s, they found the perfect recipe: homes, hope, and a little financial magic. Here's how it worked. Every time a bank gave out a mortgage, it got a steady stream of payments, small monthly checks from homeowners. But instead of waiting 30 years to get that money back, the banks realized something. They could sell the right to those future payments to investors. Right now, instant profit. So they gathered thousands of mortgages, some solid, some shaky, and blended them together into giant pools. These pools were then sliced into different layers, or tranches. The top layer was considered safe. It would get paid first. The bottom layer was risky. It would only get paid if everything went right. To investors, it looked brilliant, like a bottle of mixed perfume. If you add a few drops of bad scent to gallons of good, who's going to notice? They gave these bottles fancy names: mortgage-backed securities and collateralized debt obligations, terms that sounded so sophisticated that even seasoned investors nodded along instead of asking questions. To Wall Street, risk wasn't something to fear. It was something to repackage. Every time they bottled up another set of loans, they earned fat fees. The more bottles they sold, the more bonuses they made. So they went back to the banks and said, "We need more mortgages." The banks went back to the people and said, "We'll give you money. The people went back to the housing market and said, "We'll buy another house." The cycle fed itself. Greed became the engine, and every new bottle of safe investment quietly hid a little more poison inside. Wall Street didn't destroy the economy overnight. They just kept bottling risk until the shelves were full and one crack was enough to make them all shatter. Every con needs confidence, and in the world of finance, confidence has a name: ratings, AAA, the three letters that mean safe. Safe for pension funds, safe for banks, safe for your retirement. But by the mid-2000s, those three letters were being handed out like Halloween candy. Let's rewind. When Wall Street built their towers of mortgage-backed securities, they needed someone to bless them, someone to tell the world, "This is gold." That's where the rating agencies came in: Moody's, Standard & Poor's, Fitch. They were supposed to be the referees of the game, the sober judges in a room full of gamblers. But here's the catch. The referees were being paid by the players. The same banks creating those risky mortgage products were paying the rating agencies to rate them. If Moody's said no, the bank would walk next door to S&P. There was always another referee willing to look the other way, for a fee. So junk debt dressed up in a suit, toxic loans got stamped AAA, the same rating as U.S. Treasury bonds. To the world, that meant no risk. Pension funds in Europe bought them, insurance companies bought them, even local governments invested, thinking they were putting their money somewhere safe. In truth, they were buying stacks of promises built on hope and fraud. When the housing market started to wobble, those AAA investments turned out to be made of air. But by then, the damage was already global, because the world didn't just trust the banks, it trusted the letters printed on the boxes. And when trust collapses in finance, numbers don't matter anymore. Fear does. The crisis wasn't born the day the markets crashed. It was born the day honesty was sold for a paycheck. The rating agencies didn't pull the trigger. They just told the world the gun wasn't loaded. Greed doesn't need a villain. It just needs an opportunity. And in the early 2000s, America had plenty. It started small. A family wanting a bigger home. A realtor saying, "Don't worry, the bank will approve it." A banker saying, "Don't worry, we'll sell the loan anyway." And a Wall Street trader saying, "Don't worry, we'll turn it into profit." Everyone was eating from the same buffet of borrowed money, and no one wanted the party to end. Mortgage brokers stopped asking if people could pay. They were paid for volume, not for quality. The more loans they closed, the bigger the bonuses. So they filled out false paperwork, fudged income numbers, and handed keys to people who couldn't afford the first payment. They called them NINJA loans. No income, no job, no assets, but plenty of optimism. On Wall Street, the demand was endless. The traders didn't care about the borrowers. They just needed more loans to package, more bonds to sell, more profits to chase. It was like a factory that printed risk and labeled it wealth. Then came the home appraisers. They started inflating prices because higher values meant bigger loans. And homeowners, they saw their property values skyrocket and thought they were getting rich, so they borrowed more on the same house. To remodel, to buy cars, to live large. It was a loop of self-reinforcing delusion. Everyone believed the same lie, that the music would never stop. From Wall Street's penthouses to Middle America's cul-de-sacs, the whole country was humming the same tune, a song about growth without consequence, profit without risk, and homes that would rise in value forever. But here's the truth no one wanted to say out loud. If everyone is getting rich without producing anything real, someone's lying. And lies, like bubbles, only float until the first pin appears. That pin was already in the air. Every bubble has a sound before it bursts. For years, America's was the sound of hammers, building new homes, new suburbs, new wealth. But by 2007, the hammers went quiet. Families started missing mortgage payments. At first, just a few, then hundreds, then thousands. Banks that had loaned billions suddenly realized the money wasn't coming back. The houses they'd financed weren't worth what they thought. The collateral, the safety net, was gone. The entire market began to wobble like a tower of Jenga blocks, each mortgage a tiny piece holding up the illusion, and one by one they started to slide out. Home values plunged, foreclosures skyrocketed, investors panicked. The safe mortgage bonds rated AAA started to rot from the inside. No one wanted to buy them anymore. No one even knew what they were worth. Phones rang nonstop on Wall Street, brokers screaming, prices falling faster than anyone could calculate. In weeks, billions of dollars of wealth simply vanished. Gone, not into pockets, but into thin air. The contagion spread across the world. British banks, German funds, Asian investors, everyone who had believed in the miracle of American housing suddenly realized they'd bought a fantasy. And then came September 15, 2008. Lehman Brothers, one of the oldest, most respected banks in America, filed for bankruptcy. 25,000 employees lost their jobs overnight. Trillions in investments were frozen. Confidence, the oxygen of the financial system, evaporated. Credit stopped flowing. Businesses couldn't borrow. Families couldn't buy homes. Even strong banks looked weak. It was a modern bank run, not with lines on the street, but with zeros on screens. Within days, the entire global economy stood still. And for the first time in generations, America faced a terrifying question. Not how much did we lose, but can the system even survive? When Lehman Brothers fell, it wasn't just a company collapsing. It was confidence itself that broke. Banks stopped trusting banks, investors stopped trusting markets, and ordinary people stopped trusting anyone in a suit. The financial system runs on one invisible fuel: belief. The belief that when you lend money, you'll get it back. That when you swipe a card, someone else honors it. That when you save $1, it still means something tomorrow. In September 2008, that belief vanished overnight. The world didn't explode, it just stopped. Money froze in place. Banks refused to lend even to each other. The credit markets, the arteries of the global economy, seized like an engine running out of oil. Across America, the ripple effects hit instantly. Businesses couldn't pay suppliers, suppliers couldn't pay workers, workers couldn't pay their mortgages, a chain reaction of fear. On Wall Street, screens bled red, stocks crashed by the hour. Retirement funds lost half their value in weeks. Panic wasn't a theory anymore, it was the default setting. Even giants began to fall. AIG, the world's largest insurance company, needed an emergency bailout just to stay alive. Citigroup, Merrill Lynch. Names that once defined stability now whispered like warnings. In Washington, officials scrambled through the night. The Federal Reserve opened every valve it could, pumping hundreds of billions into the system, not to make anyone rich, but just to keep the lights on. Still, fear spread faster than money could move. People rushed to ATMs. Small banks saw withdrawals surge. Every headline felt like the end of something permanent. It wasn't just numbers collapsing, it was normalcy. Jobs disappeared, homes emptied, and behind every chart and headline was a family losing the future they thought they'd built. For a moment, the world didn't know if money would still work tomorrow. And that's the moment when governments decided they couldn't just watch anymore. The rescue was coming, but so was the outrage. When the world froze, Washington panicked, not because they cared about Wall Street's bonuses, but because the collapse was spreading into every paycheck, every store, every home. The U.S. government did what it swore it would never do. It stepped in to save the same banks that caused the disaster. The plan had a name: TARP, the Troubled Asset Relief Program. $700 billion to buy toxic assets and rescue failing institutions. To many Americans, it felt like betrayal. Wall Street got bailed out. Main Street got wiped out. While ordinary people lost jobs and homes, the same executives who helped build the crisis were getting lifelines, not handcuffs. The anger was volcanic. Protesters filled the streets. Talk radio and late-night TV turned the phrase "too big to fail" into something that tasted bitter on the tongue. But behind the outrage was a brutal truth. The system couldn't survive without its sinners. If the government let the giants fall, the entire global economy would go down with them. So the Federal Reserve opened the floodgates. They slashed interest rates to zero. They printed money by the trillions, a policy politely called quantitative easing. Stocks recovered, banks stabilized, Wall Street celebrated, but something had shifted forever. The gap between those who owned and those who owed became a canyon. We had rebuilt the system. but not the trust that kept it standing. For the average American, the recovery felt like watching someone else's victory parade. Their wages didn't rise, their debts didn't shrink, and the people who'd played by the rules wondered if rules even mattered anymore. The crisis had proven one thing: money is man-made, and so are its morals. The bleeding stopped, the markets breathed again, but America's belief in fairness never fully recovered. When the dust finally settled, America went quiet. The headlines moved on, the markets healed, and people tried to forget, as if the whole thing had been a bad dream. But history doesn't forget that easily. The 2008 crisis wasn't just an economic event, it was a mirror. It showed us what happens when belief becomes blind and when confidence becomes currency. For years afterward, politicians promised it would never happen again. New laws, new oversight, new rules for the old game. But the truth is, the players didn't change. Only the stage did. The same greed found new clothes. The same hunger for easy money moved from mortgages to tech stocks, from Wall Street to Silicon Valley. Different product, same story. Because the crisis was never really about houses. It was about human nature, our obsession with growth, our addiction to leverage, our belief that tomorrow will always bail out today. In 2008, America learned how fragile prosperity can be, and how quickly the powerful can rewrite the rules when their world is at stake. But the most dangerous part? We didn't fix the cause. We just patched the consequences. Homes were rebuilt, bonuses returned, and the stock market hit new highs, even as millions of families never recovered. Yet, in every grocery store, every gas station, every paycheck, the echoes remain. You can still feel them in the price of things, in the distrust of institutions, in the quiet fear that the next crash isn't a question of if, but when. Because bubbles don't start with numbers, they start with stories, and America is still very good at telling itself beautiful lies. The 2008 crisis ended, but the habit of believing in magic paper never really did.